ME Group International shares surged as much as 12% on Monday after the company reported first-half results that showed profit before tax falling 3.8% to £32.7 million and an interim dividend cut of 6.5%. That combination, lower earnings, a smaller payout, a share price still more than 50% below its 12-month high, would ordinarily produce a further sell-off, not a double-digit rally. The bottleneck that explains the apparent contradiction lies not in the photo booth business the market has been selling for 2 years, but in the Wash.me laundry operation that now contributes more than half of the group's entire operating profit. The photo booth business, the one that built ME Group's 40-year track record, experienced a significant vending revenue decline of 17% in April alone, driven by reduced consumer travel and official photo ID demand following the outbreak of conflict in the Middle East. France, the group's largest and most profitable single market, was hit hardest as consumer confidence contracted. The June profit warning that followed sent the shares sharply lower, and the stock entered today's results trading near the bottom of its 12-month range. What the market began repricing today is the question of whether that decline is the whole story, or merely the distorting surface above a structurally different business underneath.
The laundry division produced first-half revenue of £54.8 million, up 16.3% year-on-year, with an EBITDA margin of 51.2%, significantly higher than the group blended margin that the struggling photo booth numbers depress. Laundry now accounts for 38% of total revenue, but 54% of group EBITDA, meaning the profit mix has already shifted materially even though the revenue mix does not yet fully reflect it. Growth EBITDA rose 7.1% on nearly flat total revenues. The underlying margin expansion is entirely a function of this shift in mix, not of operational leverage in the legacy business. The strategic anchor for the second half is the partnership with Asda, where the first WashMe unit was installed in Birkenhead in June, with an ambition to expand to as many as 700 machines across Asda's supermarket and petrol station estate. Management also renewed long-term contracts with SNCF and RATP, two of France's highest footfall transit operators, securing recurring income in the very market that saw the sharpest consumer pullback. A trial with Aldi is underway in Austria, covering 25 units, with results intended to unlock a country-by-country expansion discussion. The group installed a net 499 laundry machines in the first half and targets 1,300 for the full financial year, weighted toward the second half as retailers typically avoid installation work in the run-up to December. The embedded assumption that consensus has been slow to price is that ME Group is not a photo booth manufacturer that happens to make laundry machines. It is increasingly a recurring revenue vending operator in which the legacy product, photo booths, generates cash with minimal new investment, while the growth product, self-service laundry, absorbs capex and expands into supermarket car parks and railway stations. The 49,000 machines currently in operation across 18 countries represent a fully owned installed base generating income every time a consumer uses them, with no incremental cost of goods sold. The shift happening is not a pivot, it is a mix change within the same revenue model, and the EBITDA margin differential of 51% in laundry versus the group blended figure is what makes that mix change disproportionately valuable.
The Investors' Chronicle did not characterize the H1 update as a buying opportunity. Its headline was direct: shares look cheap for a reason. The bear reading is supported by numbers the recovery narrative does not erase. Profit before tax is £32.7 million against £34.0 million a year earlier. Full-year guidance of £69 to £74 million compares with £78.2 million delivered in the prior financial year. The dividend was cut. Germany, historically one of the strongest photo booth markets, faces a regulatory barrier following changes to its official photo ID certification requirements, and ME Group is still seeking reapproval to re-enter parts of that market. These are not sentimental concerns. Against that, the recovery in May and June is not management assertion, it is quantified in the H1 statement. Total vending revenue in May rose 11.1% year-on-year, with WashMe up 25.9% and PhotoMe recovering modestly to plus 1.8%. The positive trend continued into June. The question both readings share is whether April was a temporary demand shock from geopolitical travel disruption or an early signal of structural photo booth decay accelerating faster than laundry can compensate. The two readings coexist in the same pool of articles because the same data supports both. April was bad enough to trigger a profit warning in June, and May was strong enough to validate the full-year guidance range confirmed today. The market has already partially repriced today. The question now is whether today's 12% move is the beginning of a re-rating or the entire re-rating. For holders, the decision turns on one number. Will ME Group install the remaining 801 laundry machines required to hit its 1,300 full-year target? Management is explicit that installation volume is second-half weighted, and that the ASDA rollout is the primary vehicle. If the installation pace accelerates as guided, laundry EBITDA exits the financial year materially larger than it entered, and the 51.2% laundry margin compounds on a growing installed base rather than on today's 54.8 million half. For a holder considering whether to sell into today's 12% pop, the near-term counter-evidence, falling profit, dividend cut, share price still 50% below the 12-month high, is real, but it describes the business as of April. The single metric that decides whether the bear case or the laundry pivot thesis is correct is whether second-half installation numbers track to the 1,300 annual target, and whether the October year-end trading statement narrows full-year PBT toward the 74 million top of the range rather than the 69 million floor. If the installation rate holds and France normalizes, the move becomes an entry into a structurally improving business still priced for its worst quarter. If Germany's regulatory barrier extends, French consumer sentiment remains depressed, and the H2 install pace falls short, today's pop is a relief rally in a declining business, and the 50% discount to the 12-month high is not a buying opportunity but a fair reflection of structural photo booth erosion.